to another episode of Agent versus Lender. And today we have Jeremy Peterson with us. Jeremy is a local real estate broker. He's a real estate investor. He is, I think he manages like a bunch of different properties. So if you're looking for anything within that realm, Jeremy's the guy. But the reason why I have Jeremy on today is we want to talk about today the market, about what's going on in real estate, what the market's like, what it's been like, and maybe where we're headed. And Jeremy is the guy that I know that he does the charts and the graphs and all the details. And so he keeps a really good handle on that. And so we want to talk to Jeremy today about what can you expect in the real estate market in the coming months, and where we've been, and what's happened during COVID, where we are today, and maybe what you can expect in the future. Of course, you know, that's probably a guesstimate, but if Jeremy, but if anybody knows, Jeremy will give you a good handle on that. So it's a mouthful. Are you up for that, Jeremy?
I think I am. I think I'm ready.
Okay, cool. So I'm just going to turn it over to you. Where have we been? So before COVID, kind of give us just a really brief, you know, where were we before COVID?
So the real, I guess I'll start in 2012, because that was the end of our last down market in real estate. And it actually, if you go back, it was almost on the calendar year. So January 2012 is when things started to turn around and improve after 4 really bad years in the market. And so the market was recovering, or began its recovery in 2012, and plodded along. In 2014, things kind of softened up a minute, where we thought we might actually start to see prices start falling, but they held steady, and then just kept climbing. And so we've had consistent price growth with the market. We've had consistent sales volume growth from 2012 forward to today. So it's really just been a story of consistent and up until recent history, until COVID, it's been a story of just consistent and healthy price growth and sales growth. And most of that was driven by the fact that that our economy was growing, jobs were growing. At the same time, builders were not keeping up with the supply that was demanded by the market. So prices have just gone up relative to all these good economic fundamentals and a shortage of housing stock. So that's the pre-COVID story in a nutshell. That takes you about 8 years of market history in 30 seconds. And and then we had COVID, right? And in COVID, so 2020, there were some rumblings in February of 20 about maybe there's some issues in China that might be causing some stir. That didn't really affect the housing market much at that time until the lockdown came locally in mid-March of 2020. And then the market, it was significant and quick, but there was a panic for about 2 weeks in the market as we saw active listings accelerate. I actually contemplated selling some of my property. I ended up abandoning some homes that I had under contract to buy as investments, because the uncertainty was so severe, and also based on what we knew about COVID at the time. We were talking about maybe a 5% reduction in population based on that, and that sort of uncertainty seemed daunting and scary. So we sort of went into a bunker for a minute, but that lasted about 2 weeks, really, until about April. And then even though we were under a lockdown in April locally, the real estate market kept plugging along and then began to take off as far as sales volume and in prices. And so we began an exponential increase in housing prices starting really in April of 2020. And that trajectory has continued up until recently. And so,
So a couple of things that you said back before COVID, you said it was a healthy market. Healthy market is just consistent growth. It's not like this giant upward trajectory. It's just kind of just consistent growth, what, 3 or 4% per year. Does that sound about right?
So, well, we were growing faster than that on an annual basis. So our prices were appreciating between somewhere between 8 and 15% annually. In fact,
that was pretty consistent over like 9 or 10 years.
Yeah, that was consistent. In fact, I just ran a chart just a few minutes before our meeting here that shows the month-to-month increase or decrease in house prices, or price per square foot is how I measure it. And when I put a trend line over that information, what it basically shows is that from 2012 up until 2020, the average increase in home prices was somewhere between 0 and 1% each month on average. That changed in 2020 to where we were approaching 2% each month. So
wow.
So
Wow.
definitely off trend for 2020 with this, and also considering that the 2012 to 2020 timeframe was a little bit off trend for Utah in general before that, because we just hadn't seen growth spurts like this for this long. And when I say growth, I mean price increases this steady, this intense, and this consistently. Yeah. So it's been really an unprecedented time in the market, and you've got an interesting thing that happens during this kind of a market is that you get a lot of market entrants. So you get a lot of new realtors, a lot of new loan officers, a lot of new people coming into the industry to service the volume of transactions that are occurring. And also because it seems easy, because you just show up and fish jump in. You put your boat on the lake and the fish jump in your boat. You don't even need to put any bait on your hook. You just show up and the fish jump in. But as we know, that doesn't last forever. For those of us that lived through 2007 and 8, we know that that things change. And those who've been in the business even longer than that, there's an ebb and flow to this business for sure.
Sure. So one other thing that you mentioned was that I think you're probably going to get into is builders weren't keeping up. So you said prior to COVID, builders weren't keeping up. So what do you mean by that?
So the way to measure demand is in the formation of new households, because new households need a place to live. And there's different there's wonky ways to define that, but think of it like a 20-year-old kid moves out of his parents' house and wants to get an apartment, or maybe he gets married and wants to find a house for him and his new family, or something like that. And so that's a formation of a household. And when you have or you have a family or somebody that moves from out of state into the state, that's household. That's a new household that needs a roof over their head. And so when you have in-migration, and then you have people becoming adults and needing places for themselves to live, they don't want to live in their parents' basement anymore. That creates demand, and so therefore we need to have rooftops to house these people. And builders, well, there's a couple factors. One is that their profit margins have been squeezed on smaller builds, and the availability of land is limited, and so they have to buy either land in an area that can be zoned high density to build townhomes or some high density housing, which is very limited because communities in Utah have a suburban feel to them, and they tend to shun higher density projects. And or they could buy a quarter-acre lot in a suburb and build a $400,000 or $500,000 house on it, which has the profit margins they need to keep their business going. So that's mostly what they've been doing, is building bigger housing, for move up buyers, and the starter homes have been lagging behind. And so the other factor too is that these guys almost got killed in the downturn, in the Great Recession. Like, their businesses, they almost all went bankrupt, and most of them are still having they have a depression era mindset where they're just not going to put themselves at risk like that again. And so they've scaled down where they were going gangbusters before. The guys that did go gangbusters before in the boom before the recession are out of business, and the guys that survived did so by the skin of their teeth. And so they know that if they extend themselves too much and there's some sort of credit crunch or some surprise that gets them, that if their credit lines dry up, they have no capital to build, and they're out of business. So they've been playing it safe and keeping themselves from being overly exposed to debt, which means they can only build so many houses at a time.
So not keeping up, really in a nutshell, that just means that there's far more demand than they're willing to, or they're able to build.
So the numbers that I've seen is that and I haven't seen these numbers recently, so I can't speak to presently, but I do know at one time, maybe 2 or 3 years ago, the backlog, or the excess demand for housing, was about 40,000 housing units. And at one time it was winnowed down to about 25,000. So they were making headway. The excess demand was being chipped away at, but it was going to be several more years before we reached equilibrium.
Okay, good to know. Okay, and I'm sure that plays into what we're going into, because I don't think we got into COVID yet, did we?
No, we haven't touched. Well, we talked a little bit about the exponential growth in COVID. Okay. And what's happened there. So,
okay.
And we could talk a little bit more.
Continuing on, where did the market go? Where did we?
Yeah, well, so yeah, the whole COVID year was interesting, because now, with everybody working from home becomes a place that you're spending a lot more time. People are more interested in what home has to offer because they're spending so much time there. And so then you get people willing to spend more on homes that they want because they know that they're going to be spending a lot of their time there. And at the same time, not only with COVID, but also with the political cycle, after the 2020 election, we saw a huge amount of migration occur into the state from other other surrounding states. That there was a major change in direction after starting in around November, December of 2020 with price growth. And what we saw was a lot of very cash flush buyers from out of state coming in to then compete with local buyers for these homes that are here. And these cash flush buyers were crowding out local buyers from the market.
Yeah.
And that was something that's happened within the last, that's been within the last 6 to 8 months, or actually slightly more, maybe 10 months, this has been going on. But that was a spigot that got opened after, that started in November 2020, because I remember distinctly shopping with buyers and bumping into, for the first time, a bidding war where somebody was willing to pay $20,000 over list price and guarantee it with cash. I'd never heard of. I always fantasized about those kinds of things, but never experienced it. It always seemed like a hypothetical situation, but it became very real, very quick, and that's become the norm up until recently.
Well, it also became even worse than that, because it wasn't just $20,000 over list price; it was $20,000 or $30,000 over appraised value.
Yeah.
So you have a list price of X. That doesn't mean your appraisal is going to come in at that point. So they're willing to guarantee with cash anything over the appraised value, because as a lender, we're going to look at not necessarily the list price, but what's the house worth? So we look at either the appraised value or the purchase price, whichever is less, and that's the value that we use in order to finance homes. And people were willing to spend 20, 30,000, and sometimes in the higher price points, even more, over that appraised price, which means they have that cash. And you're right, man. I just saw so many first-time buyers just getting squeezed out of the market.
Yeah, my most recent sale, I just closed on a listing here in downtown Ogden. We put it on the market. We had 4 offers in 3 days. We listed the home at 420, and our high offer was 460. And they guaranteed $40,000 in cash above, above appraisal. And yeah, and it just just takes your breath away to see those kind of figures. But one of the things that this does, though, is that it puts a floor underneath the housing market. So a lot of buyers are saying, hey, I'm going to wait until the market comes down. And that's not how the market, not how the real estate market works. Because even though the prices may be high, those prices are underpinned with a mortgage, and people don't want to walk away or pay to sell their home. They usually want to walk away either break even or with some cash to go on to their next home. And so if they can't get their price, they just won't sell, and they'll wait, for the market to do that. The stock market, on the other hand, it goes up and down because that's all just pure cash. But we appear to have repriced the market during this latest run up, and we've kind of hit a new price level where things are at.
So those people that decided to wait until prices come down, and I had multiple people tell me the same thing, and I cautioned them about, a couple things. Is one, over time, I think I ran some charts here not too long ago that showed what the prices were over the last, I think, 80 years. And there was only seven or 8 times where we had declining markets. And most of those weren't very big, huge declines. They were, you had the Great Depression, you had the one in 2007, 2008, and most of them were just little blips. They weren't huge declines.
Right.
The rest of the years were an increase in prices. So the flaw in thinking you're going to wait till prices come down is that you have to think that we are in an overbought market, or that there's a depression or recession in the near future. And I just don't know that that's a really great strategy because of and one other thing is even though the prices came down, and even the one in 2007, when there was about a year and a half or so, 2 years of decline in the market, and it only took 3 or 4 years before you were back to that same level, and then from there it's just gone past.
Right.
So there's the flaw. I'm thinking I'm going to wait till prices come down. Is the chance of that happening is not really high.
Right. And the only thing I could think of is that as far as, from why a buyer would wait would just be preparation, right? Getting enough savings, getting their financial house in order enough that they're ready to jump when the market, that door opens for them to do so. Because, this latest run up has been so fast that it has outpaced people's ability to prepare. You can't save fast enough to get that down payment to make sense, because it just, now the down payment requirement is, 30% bigger than it was a year ago. and so if that trend were to continue, you would never be able to get into a home. But that actually, a little foreshadowing here, that opportunity is probably going to be coming up again soon. So anyway.
Yeah, that's another very good point that I've made with other people as well, is like, unless you're putting away $1,000, $2,000 a month, you're not keeping up, you're actually you're actually losing ground. So, but maybe the market's going to shift, and maybe you can share some of those insights with us as we come out of COVID, kind of where we are now and maybe where we're headed.
Yeah. So one of the things that I mentioned in one of my own little market updates that I did in June was I titled it "Unsustainable Extremes," and in June we were talking about May's figures. So in May, we had increased 35% year over year in pricing based on price per square foot, which just is mind-blowing, because often, people would wait 10, 15 years to see that sort of price appreciation. And so for it to happen in 1 year it's jarring to see that kind of figure. Obviously, and just like talking about saving money for a down payment, and if you can't save fast enough to keep up with the pricing, like that's really discouraging. But that momentum, that rate of change is so high that it's not natural, and it can't sustain itself like that in the long term. So right now, Weber County on average is sitting at $196 a square foot. That's average. That's all the neighborhoods put into a big pot together. And
so to put that in perspective, I bought my house 6 years ago, and I don't know if you saw me doing something over there. I was just calculating what I paid per square foot, $83.
$83 a square foot.
$83 per square foot. And now it's how much?
It's $196 a square foot.
Yeah. So it's more than doubled in 6 years.
Yeah. It's
like 150% in almost in
yeah, really. Yeah, really it is. Yeah, I sold a house recently on Jefferson Avenue, 20th block of Jefferson in Ogden. I sold that home in 2009 as an estate sale, and my clients paid $100,000 for it. It was a brick bungalow. It was grandma's house, had blue shag carpet in it, 1950s kitchen, and some linoleum flooring, but otherwise a cute bungalow, in a nice quiet neighborhood. So fast forward, we just sold that home. Now, keeping in mind, I had the home listed back in 2009, and I think we had it on the market for about 4 months. I listed it again. Yeah, it was hard to sell. And we finally found a buyer who'd take it, and we had it listed at 110, and we sold it at 100. We finally dropped the price enough to get it to clear the market. Well, we listed it at $225,000 at the end of June, and we had 17 offers in 3 days, and it sold for $305,000 cash.
Wow.
Yeah, and virtually the same home, right? Same kitchen, same shag carpet. They did put in some new windows and a new roof over that period of time, but other than that, virtually the same home. And yeah, so just a remarkable increase. So one of the things, and you mentioned earlier that you felt like we're at an inflection point in the market, and I felt like that back in June. Like, I'm like, this is just too crazy. It's been getting crazier and crazier, and my tolerance for crazy, I've been desensitized now. Like, nothing surprises me anymore. But I felt like, okay, the market at some point has to say, we're just not going to do this anymore because we can't. And so that actually is bearing out right now in some of the charts that I've put together, that there has been, we have reached the limits of what the market can do. And so in May, we were at $196 a square foot. June, we were at $196 a square foot. And July, we've held at $196 a square foot. So for the past 3 months,
Interesting.
yeah, there has been no price movement over the last 2 month periods. And the first week of August is also seeming to support this trend, is that we are plateauing on price right now. If you look backwards and you say, okay, well, where were we in August of 2020 versus August of 2021? Well, sure, it still looks like there's a huge price growth, from a year ago at this time. But what we're finding, or what I'm seeing in the charts, is that we are decelerating very quickly, because on a month-to-month basis, we're not going up. So the elevator may have reached the top floor, and now we might chug sideways for a minute. And the reason that this causes me to ask, well, why are we chugging sideways now? How come it didn't happen earlier, or why didn't it happen later? And how is that related to the big run-up that we saw? And some of this, I believe, has to do with just the amount of stimulus money and just printing of money that's washed over the market, and people have just taken those resources and funneled them into the thing that they think is most important, which in this case happens to be, housing and transportation. That's the other factor too. Right. Oh, the other thing too, and you've probably felt this, that might be why you're alluding to the fact that we're at an inflection point, is that July 2021, so last month, saw a I got it written down on my notepad here.
I don't think I actually said we were at some kind of a point where an inflection point. I think I actually mentioned that to you prior to the podcast. So for those that are listening, I actually talked to him just really briefly before the podcast and said, man, I think there's a shift going on right now. And I said, but don't tell me the answer, because I always want to be surprised. So I'm anything
surprise.
Yeah.
Yeah. So he said a lot of other things that I won't mention too, that I can't repeat. So our sales volume for July was down 27% year over year. Our transaction volume for July is down 27%, which is huge. That's huge. That's a headline number. That is the biggest number since. I actually haven't gone back to compare it, but I would say probably back to 2011 or 10. That big of a transaction drop. Obviously, the different scenario, because the transaction declines back then were related to a breakdown in the finance sector and all kinds of economic problems. This is, we have the opposite problem now. Everything's so good, and yet we're having a transaction breakdown. So
is that just because there's lack of inventory, or is there something?
No, the inventories are the same. So, I mean, the active number of listings, and I just checked today, active number of listings available today is the same as last year at this time. So it's not a shortening of supply. It's I think what has happened is we've reached this point now where interest rates were dropping and consistently dropping for a period of time, which was driving up sales volumes and transaction volumes. Rates have reached a bottom, at least right now. They're kind of just chopping sideways a bit. So that momentum to get people into the market, now we're just dealing with one of those scenarios where you say all things being equal, right? Interest rates are being equal now. And so now all things being equal, people are looking around saying, I can't afford it now. And buyers that would be drawn into the market from declining rates are staying out, because they're just like, hey, if rates were a point lower, I could get in, but I can't, because they're at 2.9%, and that's just too high for me.
Okay, so which is a good question. So sorry to cut you off.
No, you're good.
But it brings up a really good point, is that even though the price of homes have gone up, your rates are still really low.
Mm-hmm.
They just like you said, they are like bottom low. And so if they don't think they can afford it now, rates are going to go up. I mean, the government is still buying, they're still buying a bunch of the mortgage-backed securities, which is
Yeah.
why rates are down. They were supposed to stop doing that a while ago, but they continue to do that, and they're supposed to start tapering that off again. And so once they, because they're the major buyers of mortgage-backed securities, which is where we get a lot of our rates from. So if you don't have buyers for mortgage-backed securities, your rates start to go up. And as they start easing off of those buying of those mortgage-backed securities, rates are going to go up. Don't think you can afford it now at 2.9%. It's going to be worse when it gets 3.5 or 3.9%. So what I don't know, and maybe this is a good question for you, is if rates go up, and maybe I'm like jumping way ahead because I know that we haven't gone through our whole scenario of coming out of COVID, but when you get to this point, remember to answer the question of what is that going to do to pricing if rates start to go up? You don't have to answer that yet because we haven't got to the end of your coming out of COVID stuff. So, but that's a good question to answer at some point.
Okay, yeah, that is a good question. And I might just answer it now because I've lost my place.
Okay, I'll help you come back to that.
But yeah, so there is a balance between, when buyers purchase a home, they're not purchasing a mortgage amount or a price, they're purchasing a mortgage payment, most buyers, right? A cash buyer is a different deal. They'll come into cash and they dictate their price. But and that's usually they usually get a discount because it's cash. But a buyer, most buyers are going to borrow, and therefore they are super sensitive to monthly payments. So if interest rates were to go up, I actually have a chart that I keep where I say the chart says what would house prices be if rates were 6.5%. Like, it's a wonky chart that I keep, but like what would that look like? And it would be basically a 30% decrease in home prices to clear the same mortgage payment at today's prices, right? Like you're just that interest would just increase those payments to a point that you couldn't afford it. So for political reasons, I don't believe that the powers that be will permit interest rates to go up too much. There might be some things that they can't do to prevent it from happening, but I think they're going to do pretty much everything they can to keep things from going up too much. And the reason being is that the collateral damage that would happen from them going up, rapidly or spiking above, 3-4%, something like that, would be catastrophic to the market. You'd basically would go down to minimal transactions happening because based on everyone's incomes right now, they just couldn't afford the payments, and so nothing would happen. Everyone would just sit around and stare at each other. You might see a lot of seller finance transactions or something like that might happen, but outright sales using loans would be hard because nobody could afford them at that moment. So if rates do go up, they might go up gradually and slowly to allow the market to digest that. But there really isn't, and also because of the amount of borrowing the federal government has done, just in general, that overall interest rates, if they were to go up, means that the federal budgets would be consumed with interest payments, which means they couldn't spend the money on other things like social programs and whatnot. And so everybody is pretty much in agreement that low interest rates keep the music going. And if they were to go up too much, that would be a problem. So the political implications of a negative outcome from interest rates going up, I think, is too high. Those risks are too high for policymakers, so they'll keep them low as much as they can. But in the meantime, you have this increase in prices that have outstripped wage growth, right? And that can't go on forever.
No.
And so, yeah. So what does so really what does that look like moving forward then? With this with this scenario, and one of the reasons going back to our plateau that we're seeing right now, the question being why is that happening? I think the reasons it's happening right now is that all that additional money that's been in the marketplace has now been injected into the general market, not just housing market, but everywhere. So now all the things that a household needs to operate, like transportation, insurance, food, energy, utilities, these sort of things, those things are going up as well in price. And now those things are now bumping into the cost of housing, right? Because you have a finite amount of dollars available in your budget each month. And, if everything else was cheap, you could, scrimp to get your house price higher. But now if everything else is starting to claw away at your disposable income that you're otherwise going to assign to housing, well, then that suddenly puts a damper on your willingness to pay more, because you got to spend the rest of your budget on these other items that you need to survive.
So, so for those that are listening, he has mentioned a couple of times that he has all these charts and graphs, and he puts a lot of them into a newsletter. I'm not wrapping this up yet because but I just wanted to if you want to get hold of Jeremy and subscribe to that newsletter, which I highly recommend it. I get his newsletter, and every time it comes out, I read it. So how would they just go to your website to sign up for that?
Well, they actually would. Usually what I do is it's a very personal list. So I don't spam people. Usually if somebody's a client or not even a client, but just somebody who wants information or whatnot, I'll usually get their email address and just add them manually to my newsletter list. I have a database of about 1,000 clients that I keep in touch with each month through newsletters. So yeah, if somebody just wants to send me an email, maybe you could put a link to the email here or somewhere.
Okay. Yeah, I'll do that. We can put a link in the podcast, or maybe we'll flash it across the screen, or if you're on YouTube, we'll put it on there. Flash it across it. You'd have to be watching on YouTube. So
yeah.
We'll put a link somewhere.
Yeah, and we do have our YouTube channel too, which is they can subscribe to the YouTube channel, our YouTube channel, which is just Vesta Real Estate, and that's where all of our fun information is.
That's Victor. So Victor Edward. Anyway, V is in Victor, ESTA, Vesta.
Yep. Hard to say, but that's all right.
That's only because that's me. Everything's hard for me to say.
Yeah. So
anyway,
yeah.
So anyway, you were talking about I think, were you wrapping up the kind of where is the market? So I'm still a little confused where the market's going. We're coming out of COVID, and prices seem to have plateaued. I don't know if seems like builders are still building a lot. But interest rates haven't gone up. Interest rates are still low. What does that look like for the future? Where do you think?
So builders are benefiting right now from the fact that lumber futures are coming down, right? So material costs they were at this painful high, and now they're coming back. I mean, they're still painful, but not nearly as much. Yeah. And so they're able to operate and build now, without worrying about their margins being totally destroyed. I think builders are going to, as long as there's excess demand, they will continue to build. It's just a question of, what their margins look like and what land is available for them to build what product, right? So I think that's going to continue. We're going to continue to whittle away at the excess demand. The market with this apparent plateau, I could be totally wrong and things skyrocket next month or something for some reason, but my gut tells me that that's not going to happen, because again, most of this happened as stimulus money was being injected into the marketplace and as interest rates were being maneuvered down, right? So this all happened, kind of just all happened at the same time. We're not going to have the injection of free money like we saw before, right? That's over with for now. Um, and there's another infrastructure bill going on right now where they're going to put another $500 billion into building projects or whatever. That might squeeze up prices a little bit because those projects will take away the construction labor from housing and steer it over to roads or other that'll gobble up labor basically and steer it in other directions. But so that might be a constriction on how long it takes to build a house and maybe even the price a little bit because wages might need to go up to compete to keep the guys there swinging hammers and framing houses. But not like it was with just giving, dropping $8,000 in everyone's bank account and saying, "Hey, have fun." That period of time is over. I think there's a couple thoughts with the COVID thing not quite being over. Like right now, it seems like the last 2 weeks, sentiment has just completely tanked as far as people's optimism, because now we've got this Delta quote unquote variant running around, and then we have all the negative press. It seemed like it just turned on like a switch, and suddenly the sky is falling again from that. I think experience has taught us it's not the Black Plague, so it's not that scary, but it's annoying and inconvenient for sure, and that might impact the way the economy responds, because travel and a lot of hospitality businesses who are just getting ready to open are going to be hamstrung by that. And Ogden is one of those too. Like we're kind of a small tourist destination, so our 25th Street particularly might be impacted by what's happening now, but they may or may not. We'll see. That's going to be coming up. But there's a couple thoughts. One was that the high price of housing might be a leading indicator, and because pricing is sticky in housing, that we'll have this high plateau, and housing will just kind of hang out there for a while and wait for wages and other things to catch up to that point. And then what we might see is transaction volumes just lower until that point that things start to equalize. And it might, that process could take, it could take years actually to catch up, all things being equal. But I don't see all things being equal in this market. I think there's a lot of things that there's a lot of volatility in different aspects of life that could impact things, in one way or the other. So what that is, I don't know. But another scenario might be that the economy starts to sputter because this Delta thing lasts longer than we would like, or it actually starts to metastasize into something more serious. And then if that were to happen, we'd go back into another scenario of lockdowns and maybe people not working. And then I don't know how they would do another round of stimulus, but you'd probably have another rinse and repeat of this cycle if it were possible. But I just don't know how you spend all that money.
I think that's a whole nother discussion of would the American people even allow us to, they would want us to go into a lockdown, would they be able to pull that off again? Because there's been so much fallout.
Yeah. So that's a volatile, that's a volatile issue. And I'm sorry I even broached the topic.
That's why I said that's a whole nother, that's a whole nother conversation, because we could delve into all kinds of stuff there. And so we won't do that.
Yeah, we want to end this thing on a happy note.
Yeah, right. That's right. Exactly. So what's your suggestion? I mean, housing is high. I mean, housing is expensive. I mean, compared to 3-4 years ago, it's pretty pricey.
Yeah. Well,
what's their options?
I'm in the real estate game for the long run, right? I'm not a speculator. I'm not a turn and burn kind of real estate guy.
You're not a flipper.
I'm not a flipper. I have flipped homes in the past. but that's not my preference. Like I like to buy and hold. And one of my, from an investment standpoint, I bought a fourplex back in March of 2007, and I took a home equity line out on my personal house and put all that money into the building to rehab it. And I estimated back then that it was going to be worth, after I fixed it up, about $285,000. And I completed the rehab in July of 2007. The company I was refinancing with went out of business about a week before I was supposed to close my loan. We found another lender, and we closed the loan with that lender 2 weeks later. 3 days after we closed the loan, that lender went out of business. And then all the lenders that were able to refinance my loan were out of business after that. So I had I would have been in big trouble had I not completed that refinance like I needed to at that time, because I had a really bad loan with that particular property. I then watched that property go from $285,000 to $180,000 in value over the course of the next 3 years. Today that property is worth over $500,000.
Nice.
So yeah.
So you still came out ahead, but it's because you're in the long run. You didn't panic.
Because it was a long run. Yeah, because in the long run, it's going to work out. And so this is what the advice I'd give buyers is that if they have a 2-year plan, it's not long enough, right? When they get into a property, they should have at least a 5-year plan, if not a 10-year plan for the home, because you just don't know what the market's going to do. But the benefits of owning they're just going to be a blessing, because you're going to get the amortization. So you're going to be paying down the principal balance, even, while someone else is waiting for the market to drop. A buyer who buys now is building equity by paying down the principal each month.
Right.
Plus they're going to get the tax benefits, which a person who's waiting around for prices to drop isn't going to get. I tell people owning a home is like having a child on your taxes. You just get this nice interest deduction. And in the case of real estate investment, it's depreciation. So if you're empty nesting, buy another house, get a rental property. That will keep your taxes low. Plus all the benefits that the home ownership entails, and the experiences that come with it. So waiting around, I would rather start the amortization clock right now than wait around for 5 years hoping for an opportunity to get a lower price that may or may not, materialize.
Yeah, hope is a terrible business strategy.
It is a bad strategy. Yeah.
So, Jeremy, always a pleasure. It's always fun to talk to you. I just bow to you, man. It's just like
we're not worthy.
Yeah, that's right. That's right, exactly. So I appreciate you coming on here and sharing some of your wisdom with us. And it's a good way to get hold of you if somebody wants to get hold of you.
Best way to get a hold of me is to call. It's 801-390-1480. I'm around town. Just if I don't answer, I'm either on the phone or on a podcast with Ron. So just leave a message.
Perfect. Awesome. And to get hold of me and my team, you can always get hold of us at 801-628-7667. And we look forward to talking to any of you. Any questions, just give us a call and we'll help you out. And we'll catch you next time on another